Hello, my name is Matt Russell. I'm an FX Power Course instructor here at FXCM. I want to welcome everybody to the daily FX walkthrough. Going to get started in just a moment. What I'm going to do tonight, as always, is walk through the latest technical report by Jamie Setley at DailyFX.com. So let's go ahead and pull up that report. If you give me one moment here. Actually, we're going to pull up DailyFX.com first. I'm going to scroll down to click on Jamie's report, as I usually do. And we can go ahead and read the synopsis on top. Dollar comes back, large ranges forming. Euro support in the 130 to 133 range, British pound inverse head and shoulder pattern, and dollar CAD bullish potential above 114.59. So let's scroll down. The euro dollar, Jamie was mentioning in his reports that I urged all of you to read. A lot of this stuff here, I can go through some of it here. Regardless of the count from 160, euro-dollar range likely takes hold over the next several weeks. A triangle is a possibility. Former resistance in the 130 to 133 area is probable support for the bottom of the expected range. So let's also scroll down now to the pound-dollar. I maintain, I'm reading Jamie's report here, I maintain that a multi-month rally in the pound-dollar is likely underway, possibly to as high as the mid-160s. We can view more in-depth British pound analysis. I'll also include that link. That's right here, what Jamie is speaking about. Near term, the right shoulder of an inverse head and shoulder patterns could be forming. This is a pattern to watch closely as we head into 2009. 145.50 to 146.75 is potential support. So let's go ahead and pull up the charts. I did go over the euro dollar and the pound dollar, but the first chart that I'm speaking about here is the Kiwi dollar, and this is all similar. We were in that short dollar trade, and then I mentioned that we might get flat now. In my opinion, what we're looking at now, we had a very sharp rally that could be the A wave, and right now we could be this could be an ABC correction, and right now, moving lower, this could be the A wave. We might wait for an A wave bottom to form, where there might be then a B wave and then a C wave for this correction to play out. So what does that mean to us normal traders out there who don't understand what I'm talking about in terms of ABC waves and 1, 2, 3, 4, 5 counts? Anyway, so moving forward, what we might look for over the next several weeks, in my opinion, on the Kiwi dollar, maybe a move down to that 56 area. As I mentioned, that trade that set up last week, we never did get that back test. But considering that the 56 figure is only 170 pips below the current prices, that's something that we can look for moving forward. And another thing to keep in mind that, as Jamie was mentioning, a range could be forming. So this is going to be sort of a tricky environment in terms of direction. We're not going to be very confident in direction. But as Jamie mentioned, there is a good chance for a range to form. And what I would say in terms of the Kiwi, just looking at this chart, 56 area would be the first area of support that I would look for a clear support level. Of course, there could be shorter-term levels, but anything, but the 56 level is a level that I would have confidence in. Next chart is the Aussie dollar, and as I was mentioning last week, this is a trade that didn't work out as prices did peak above that 70 figure. So moving forward now, I just keep this on the radar. We're sort of meandering here sideways. We could also on the daily chart here add a simple support line, which we might do. And moving forward, so might look for a move down to this simple support line on the daily over the next couple of days, and this would be similar to that 56 figure that I'm speaking about on the Kiwi. So now to the charts that we were speaking about in the report. This is the euro-dollar chart, the same chart from Friday's report or Thursday night's report, and we can see, as I was mentioning, that perfect kiss of that 61.8 fib level, but then we had a very sharp reversal. I was mentioning how we might look to enter the pair short near the 145 or near the 146 figure, but prices didn't give us a chance to do so as this sell-off has continued, and it has been quite steep. So moving forward, nothing, the same thing that I would say here, nothing really jumps out at me here. The first area of support could be right here in the 38, I'd say 138.50 area to about the 137.50 area. That could be the first area as support. But what Jamie was speaking about, that 130 to 133 area could be the low of the range that might form. And if we want a parallel to the Kiwi chart, that would be about that 133 figure. This is about the same pattern that we have on the Kiwi chart. So that's something to look for moving forward. I apologize. I know a lot of these levels are far away from current prices, but that's just the current market environment that we're in right now. We just have to kind of get through this time, wait for those, wait for the market to give us a good entry. But in the meantime, just be patient and possibly stay flat. Last chart is the pound dollar. As Jamie was mentioning, this pair could be headed to the mid 160s. I agree in terms of Jamie's assessment here. And just looking at this chart blindly, you can see the rally from about the 143 figure up to about what's this print here. I would say just below that 158 figure. You can argue that's impulsive, and you can argue that this is corrective. The only thing, this is pretty sharp to be a corrective move, but I'm still going to lean towards the corrective nature of the sell-off from just below that 158 figure. As Jamie was mentioning, the possible inverse head and shoulder pattern, and I would pay attention to that anywhere below that 146 figure. So moving forward, and as the moves have been, very large, very extreme. So right now, that 146 figure is only about 300 pips beneath current price action. That can certainly be attained within a day or two, considering the volatility in this pair over the past several months, or even up, I'd say 6 months or 7 months. So that's something to look for moving forward, as Jamie was mentioning, a possible inverse head and shoulder bottoming pattern, which could form, and the right shoulder would be near that 146 figure. This is one of my favorite patterns, an inverse head and shoulder or a head and shoulder pattern, only because the risk to reward at the right shoulder on both a regular head and shoulder pattern and inverse head and shoulder pattern is extremely favorable. So what we might do now is wait for prices to come down just below that 146 figure, look to enter, and place our stop below the low over here, which is 145. What is that? 145.58. So that would be the low on the left shoulder right here that I'm pointing out. We might look for a similar low over here on the right. And again, the major benefit is that we might be able to place a 50 to 75 pip stop below that left shoulder level over here, and the upside is tremendous because if that pattern were to hold, we can gather from that the minimum expectations for our profits would be this high over here, which is just below that 158 figure. So just be patient over the next couple of days. Again, my name is Matt Russell. I'm an FX Power Course instructor here at FXCM. Thanks for listening.